Hey everyone, and welcome to this explainer. Today, I'm putting on my senior financial analyst hat to do a complete, deep dive architectural teardown of the State Bank of India's FY 2025-26 business model. We are going way past the surface-level marketing here to look at the actual mechanical engines driving this banking behemoth. We're talking about a legacy institution that has aggressively, and I mean aggressively, transformed into a digital-first powerhouse serving over 53 core customers. So let's grab our tools and unpack exactly how they managed to operate at such a mind-blowing scale. Here is our roadmap for the day. We're going to systematically disassemble this massive profit engine across 6 key pillars, starting with their product ecosystem all the way down to their macro risks. All right, let's jump right into part 1, product ecosystem and value. We're looking at hyper-personalization at a truly massive scale. To really grasp SBI today, you gotta wrap your head around the sheer, absolute mass of the operation. It's frankly staggering. Their total business metric has officially crossed 109 trillion rupees. That's fueled by deposits hitting 59.8 trillion rupees, which is an 11.03% year-over-year growth, and advances reaching 49.3 trillion. Honestly, this isn't just a bank anymore. It's practically a foundational load-bearing pillar of the entire Indian macroeconomic system. But hey, scale without efficiency is just a massive liability, right? We aren't just looking at size. We're looking at an incredibly impressive 18.57% return on equity. Generating an 8,032 crore rupee net profit on a balance sheet of this size, that requires a meticulously tuned operational machine. If you're an investor, this matters, because converting raw deposits into high-yield returns at this volume is literally the ultimate test of a bank's infrastructure. And their risk mitigation is just as wild. Their net non-performing assets have been remarkably compressed down to a tiny 0.39%. Think about that for a second. When you have nearly 50 trillion rupees in advances, keeping your bad loans strictly confined to a fraction of a single percent is a massive testament to their highly sophisticated data-driven underwriting. For market watchers, there's no better indicator of a structurally sound loan book. So how are they actually delivering all this value? The absolute tip of the spear for their product ecosystem is YONO 2.0. Listen, this isn't just some basic mobile app. It's a unified digital banking ecosystem that's driving hyper-personalized, AI-driven journeys for over 10.02 crore registered users. YONO smoothly integrates payments, lending, and investment services all in one place. It provides an end-to-end onboarding experience that dramatically crushes customer acquisition costs while practically serving up cross-selling opportunities on a silver platter. Now, when we shift to the enterprise tier, the whole value proposition pivots to working capital efficiency. CMP NextGen is their corporate cash flow engine, and the volume moving through this thing is insane, an astonishing 130 lakh crore rupees pumped through an automated pipeline. It gives government ministries, large corporates, and NBFCs agile, scalable solutions for bulk transactions and automated reconciliations, fundamentally speeding up their integration turnaround time. Moving right along to Section 2, granular customer segmentation. Let's map out this end-user matrix and see exactly how value is extracted from incredibly diverse groups. Just look at how surgically they stratify their wealth tier. They've zeroed in on 12 lakh targeted customers who sit in that specific total relationship value bracket of 30 to 50 lakh rupees. To cater to them, they've deployed 1,106 relationship managers across 259 physical wealth hubs, completely backed up by virtual relationship associates. And it's working. This highly structured approach has generated an investment AUM of 78,198 crore rupees. That's a massive 33% jump year over year. Operationally, we're witnessing a radical shift here. They are actively abandoning the legacy, localized branch customer model. You know, the old idea that you're tied to the physical building down the street. Instead, they're pushing a unified, borderless bank customer approach through digital access. And to help people make that digital leap, physically in branch, they've rolled out Seva Sarthi, essentially floor coordinators stationed at around 8,000 high-footfall branches to elevate the experience and actively handhold digital adoption. This segmentation matrix literally stretches from one extreme of the economy to the other. At the very top, you have the corporate accounts group using a global relationship manager model to target top corporates and manage foreign institutional investment cells. But then, all the way at the grassroots level, they're leveraging 9 sponsored regional rural banks across 196 districts. These RRBs are pushing hard on microcredit, driving a 15.03% expansion in MSME advances and a massive 42.13% growth in gold loans. It's the ultimate barbell strategy. Okay, part 3, Microanalysis of revenue streams and capital allocation. Let's do a teardown of the exact monetary drivers fueling that 80,032 crore rupee net profit. When we isolate the geographic and structural revenue, the contrast is stark. Domestic revenue completely eclipsing foreign revenue at over 6.6 trillion rupees compared to just over 48,000 crore. But the real story is in the segments. It is heavily anchored by retail banking, which generates over 2.6 trillion rupees on its own. Corporate banking pulls in 1.49 trillion, and their treasury operations bring in over 1.35 trillion. Retail is without a doubt the undisputed cash cow here. But they aren't just making money on loan interest. Digging into the non-interest drivers, observe how aggressively these fee-based models pad the bottom line. Insurance premium income alone is a staggering 108,918 crore rupees. Commission, exchange, and brokerage fees add another 36,439 crore. Credit card membership fees pull in over 8,366 crore. They are relentlessly monetizing absolutely every single node of their customer network. Which brings us to Section 4, Operational Infrastructure and Go-to-Market Mechanics. Let's look at where management is aggressively investing capital to sustain these fat margins. The central mechanical beating heart of their digital supply chain is the RLMS, the Retail Loan Management System. Don't just think of this as software. It is literally an automated factory for the entire retail loan lifecycle. It integrates everything from sourcing and processing to sanctioning and recovery, all into one seamless, frictionless flow. Let's quickly walk through the mechanics of this digital assembly line. It starts at the top of the funnel with sourcing via their Retail Assets Acquisition System, or RAS, and the Yono app. From there, boom, it moves into end-to-end paperless processing and digital sanctioning. Finally, post-disbursement, it seamlessly hands off to the Loan Accounts Management System for delinquency management. For investors, this is the holy grail. It removes human error, radically speeds up turnaround, and drastically lowers the operational cost of goods sold on every single loan. And how are they finding these people? They've completely evolved their go-to-market mechanics with a radical shift to digital-only marketing. They're entirely bypassing the high costs of print communication now. By leveraging a centralized ad tech ecosystem and a customer data platform, they get this unified customer view that lets them hit you with precise real-time engagement via SMS, WhatsApp, and in-app notifications. It severely lowers their customer acquisition cost while making their leads so much higher quality. Section 5, the competitive moat. How exactly do you protect a beast this size from being nibbled to death by highly agile, pure-play fintech startups? The answer is heavy, incredibly well-funded R&D infrastructure. They formed a dedicated AI lab strictly for rapid prototyping and enterprise-wide AI literacy. By hardwiring their absolutely massive proprietary customer data sets directly into intelligence models, they optimize everything from credit underwriting to fraud detection. This isn't just something a startup can spin up overnight. It's a compounding intelligence capability that essentially locks in their market share and builds a massive wall against disruption. Finally, let's wrap up with Section 6, Strategic Horizon and Macro Risks. Because no strategic teardown is complete without projecting this roadmap against the macro vulnerabilities the executive team is actually sweating over. The most critical systemic vulnerabilities flagged here are cybersecurity and data privacy compliance. I mean, a breach at this scale would be absolutely catastrophic, right? To neutralize this, management is actively embedding DevSecOps directly into the core of their RLMS and digital platforms. This bakes security and data protection compliance right into the software development process from day one, rather than slapping it on as an afterthought. Looking a bit further down the horizon, their strategy heavily targets global macroeconomic ESG mandates. To secure future capital and stay resilient against climate transition risks, they are going all in on green financing. We're talking green car loans for EVs, the Agar loan for residential rooftop solar, and big integrations with government schemes like PM Kusum. They are literally financing the country's multi-decade shift toward a low-carbon economy. Which leaves us with one massive, final, strategic question to chew on today. As SBI continues to scale this hyper-personalized digital-first infrastructure across over 53 crore customers, will its compounding AI moat and automated technological chassis stay secure enough to continually outpace emerging regulatory headwinds and those ever-present systemic cyber vulnerabilities? It is an incredibly high-stakes balancing act of extreme scale versus operational risk, and I promise you, it's going to define the future of global banking. Thanks so much for joining me on this teardown, and keep analyzing those architectures.